This past weekend, while many were busy scrolling their phones, the United States launched what the Pentagon is calling major combat operations against Iran. Surprised. When markets opened Monday morning, the impact was immediate. Oil surged 7.4%, gold jumped past $5,300 an ounce, and Dow futures were down by more than 500 points. As expected, retail investors reacted the way they always do during these crises, panic selling, acting on fear instead of historical perspective. Serious. Over the weekend of February 28, 2026, the U.S. and Israel coordinated airstrikes against Iran in what is now being called Operation Epic Fury. Iran's supreme leader, Ayatollah Khamenei, was killed. Multiple government ministries in Tehran were targeted, and within hours, the Strait of Hormuz, the world's most critical oil choke point, was effectively blocked. This matters to your investments because over 20% of the world's daily oil and liquefied natural gas flows through that narrow passage. Shipping companies rerouted tankers, insurers pulled coverage for vessels in the area, and Dubai's Jebel Ali port, the Middle East's largest container terminal, halted operations completely. This is not a minor event. The key question is this: is this the end of the road for long-term investors, or could it be the start of an opportunity? History provides a guide. From the Cuban Missile Crisis to the Gulf War, 9/11, and the 2003 Iraq invasion, panic has consistently proven to be the wrong response. Let's take a closer look at the market reaction. U.S. crude oil, WTI, jumped 7.4% Monday morning to $72 a barrel, while Brent crude, the global benchmark, spiked to $78.37, briefly touching $82 in early trading. Barclays is warning clients that Brent could reach $100, and UBS has projected prices could hit $120 if the strait remains closed. Gold, meanwhile, surged over 3% in a single session, surpassing $5,300 an ounce, reaching record territory. JP Morgan has raised its gold price target to $6,300 by December 2026. Meanwhile, U.S. equities showed a mixed picture. S&P 500 futures fell over 1%, Dow futures dropped more than 500 points, and the Nasdaq followed suit. But not every stock lost value. ExxonMobil and Chevron rose, and defense contractors like Lockheed Martin, Northrop Grumman, and Raytheon Technologies gained 2–3%. The market isn't collapsing, it's rotating. The smart money isn't fleeing, they're reallocating. Here's what separates typical investors from institutional money. Retail investors react emotionally. They panic sell index funds, frantically search, "Should I sell everything?" online, and watch oil prices spike on their phones with growing anxiety. Institutional investors, however, act on knowledge, not fear. The moment the first strike hit, hedge funds, sovereign wealth funds, and major money managers were already adjusting positions. Many had oil futures in place, anticipating geopolitical tensions. They are now buying gold, shifting into defense, and quietly acquiring treasury bonds as yields drop. Classic moves when fear escalates. This pattern has repeated for decades. A geopolitical shock triggers panic selling, smart money buys the fear, markets recover, and retail investors regret selling. After 9/11, the market fell sharply but began recovering within weeks. Following the 2003 Iraq invasion, oil spiked, stocks dipped, and then equities climbed for years. Even in June 2025, when Israel first targeted Iranian nuclear sites, stocks briefly sold off but quickly recovered once the Strait of Hormuz remained open. The market remembers history, and savvy investors use that memory to their advantage. The Strait of Hormuz deserves special attention. Picture this. Imagine every gas station in the US, Europe, China, Japan, and India receives fuel through one single pipeline, and someone puts a hand over it. That's the strait. On average, over 14 million barrels of oil per day pass through this narrow channel, accounting for roughly a third of all seaborne crude exports. About 3/4 of that supply heads to China, India, Japan, and South Korea. Right now, tankers are stalled, shipping companies are halting bookings, and vessels are anchored outside the strait awaiting clearance. The critical variable for your portfolio is how long this disruption lasts. If the strait reopens in days, oil prices could retreat, markets may stabilize, and panic trades would reverse quickly. If it remains closed for weeks or months, we could be looking at a dramatically different scenario. JP Morgan analysts outline the factors driving oil prices, the scale of supply disruption, duration, alternative supply mobilization, and geopolitical developments. Brent surpassing $100 becomes a realistic possibility, inflation could accelerate, the Federal Reserve's rate cut timeline might extend, corporate margins could be squeezed, and the S&P 500 could face a steep drop towards 6,000 from current levels near 6,850 under worst-case projections. Yet, there are mitigating factors. Iran's foreign minister stated that the country has no intention of closing the strait. OPEC Plus announced an increase of 206,000 barrels per day, and Saudi Arabia has a backup pipeline that bypasses Hormuz entirely. Prior to this crisis, global supply fundamentals in 2026 indicated an oversupply, so this is a geopolitical premium added to an already well-supplied market. The key is to size your positions carefully, not to panic. Now, let's focus on the lessons that should guide your investments. Lesson 1. War creates both winners and losers. This isn't a uniform market crash like 2008, it's a sector rotation. Right now, winners include energy, defense, gold, U.S. Treasury bonds, the U.S. dollar, and the Japanese yen. Losers include airlines due to skyrocketing jet fuel costs, shipping and logistics companies, consumer discretionary sectors as higher fuel prices reduce spending, and any company heavily exposed to Gulf region supply chains. If you hold an S&P 500 index fund, you own both winners and losers. Understanding this balance is crucial. Lesson 2. Panic isn't a strategy, and neither is denial. This isn't about ignoring the conflict. It's about avoiding permanent decisions based on temporary emotions. Between 2003 and 2011, crude averaged around $72 per barrel in today's dollars, above $100, and the global economy still grew, producing wealth and rewarding patient investors. The question isn't whether this is scary, it's what history shows happens next. Lesson 3. Inflation could change the game. If oil stays elevated for months, inflation could accelerate. That might force the Federal Reserve to halt rate cuts or even raise rates again, affecting growth stocks, real estate, and any sector reliant on cheap borrowing. This isn't the base case, but it's a scenario a prepared investor must consider. Lesson 4. Gold is critical. Its surge above $5,300 isn't a coincidence. Global investors, particularly in Asia and Europe, have been reducing exposure to dollar-denominated assets over the past year amid policy uncertainty from Washington. Gold has become the go-to safe haven. JP Morgan's $6,300 target by December 2026 reflects serious institutional expectations. While it's not a call to invest your life savings in gold, those without any exposure should reconsider. Lesson 5. Crisis creates opportunities. Every major disruption presents moments where quality businesses are undervalued simply because fear dominates. After the Gulf War in 1991, the market rallied strongly. When Iraq stabilized in 2004, energy infrastructure became one of the decade's top-performing investments. In March 2020, those who bought during peak COVID fear made extraordinary gains. This conflict may not be over, but embedded within it are companies likely to be worth far more in a decade. Your role is to identify them. So how do you stay calm when the world seems to be on fire? Don't try to predict the strait's reopening or Iran's next move. No one knows. What you can trust is the resilience of the U.S. and global economy. Those who prosper during crises aren't the ones predicting events perfectly. They're the ones anchored in long-term value while everyone else panics. Right now, the advice is simple. Don't sell quality out of fear, don't buy junk because of hype, and don't mistake a loud headline for a permanent shift. Humanity still needs food, technology, medicine, housing, and builders. Geopolitics will make it bumpy, but bumpy doesn't mean broken. If this story gives you even one insight, share it. Someone you know is likely panicking over their portfolio, and you can provide clarity instead of fear. Subscribe to Terra Alert News for insights that help you think like an investor, not react like a trader, and drop your questions about Iran and the markets in the comments below. This version preserves all details, narrative flow, and investment insights, while presenting it in a polished, professional, and readable style.